Hey guys, a lot going on this week. So here we cover a lot of macro, so that could be anything. And the reason why I think a real macro trader is somebody who can trade anything in front of them, from individual stocks in a random country like Turkey, all the way to a bond market. I think we trade everything in front of us. So Kashop's been talking about the semiconductors, SMCI, Nvidia, and we had a show on here talking about Nvidia fraud at one point. So let's go. We'll take like 10 minutes. We'll get through that, and then we'll cover gold. We'll cover some other areas. And if anybody has questions, feel free to write in. Got a great panel today. Myself, Sam, and Kashop. So we could cover just about anything you want to throw at us, really. So Kashop, what are you seeing in the semiconductor market? And then Sam, if you have any charts you want me to bring up, let me know.
For sure.
Sure. So, the wave in semiconductors has been driven by ChatGPT, followed by every single quarter of NVIDIA's revenue growth. And as you know, I have always been skeptical as to how they have been achieving those numbers. So I've looked behind it. I have done plenty of research. You can see it on my highlights. So starting from the August 2023 quarter, I pretty much covered every single quarter of NVIDIA and showed how exactly. So at first, it wasn't exactly fraud. They were just playing with the accounting rules in terms of bringing revenues forward or playing with the numbers in other ways. Like you can read my threads, you'll see that. And when I was researching NVIDIA, one name kept popping up, and that was Supermicrocomputer, SMCI. Now, if you pull up the stock chart, it looks fantastic. Like this stock chart puts most cryptos to shame. It started out at around, so the split adjusted price, it started out at around $3 back when it was delisted, I think in 2020, and it moved all the way to something like $120. In fact, it is the first stock in all of history to achieve a daily RSI score of 100. So no technician would have ever imagined it, and it was something that we would think is as impossible as negative oil prices, but we got it. And now here we are, one day away from it being delisted from the NASDAQ for accounting fraud. And what exactly is the story here? The story here is this is a Taiwanese company and they have a known history of committing accounting fraud. So if you remember, there was this big wave of prior to 2014 or so, we had a huge amount of Chinese stocks doing their IPO on the New York Stock Exchange. And later on, investors found out that there was nothing behind it. So there was a company called Sino Forest, which apparently, they claim to own big lots of forests in China. And turns out there were no forests. It was all a fake. And there have been plenty of such Chinese companies which have used US capital markets and gotten away with fraud. And the coffee, I think, is the example that everyone remembers, the Starbucks of China. Imagine 1.4 billion people drinking coffee, the stock should soar. And then management came out and said, sorry, guys, we committed fraud. And the SEC kind of started cracking down on all these cases in the past decade. And Supermicro Computer was actually delisted in 2018 for accounting fraud. And then they changed the CFO, and then they got relisted at $3, and stock ran all the way up to $120. But it's like the old saying, the leopards never change their spots. So they just keep playing fast and loose with the numbers, and not just fraud in terms of the ways we regularly think of it. So they also had a lot of related party dealings. So what they did was the CEO, he has vendor contracts with people who are his blood relatives and immediate family. So there were a lot of kickbacks involved. There were a lot of non-arm's length negotiations involved, and all of that came to a head once Hindenburg released a research report showing all of it in plain white detail. And when that happened, their auditor Ernst and Young had to take notice, and this was all around end of August, around 25th of August. So Ernst and Young took notice, and they said they are not going to sign off on the 10K. And at that point, what's crazy is that the stock started going up on the news. Everyone is like, oh, Hindenburg is wrong. The news is overblown. Look, this is a stock that was at $120 and now it's at $30, 75% off, guys. It's such a big bargain. And this was exactly how it was touted in the media. And it was shocking that all the big sell side firms, Goldman Sachs and the JP Morgans, BofA, all these guys, they all started recommending the stock saying the accounting issues are overblown. And it is just something that I cannot imagine possible because here you have the auditor saying they will not sign off on the 10K and the stock goes up on the news. And that was how wild the AI mania was that people just ignored reality at that point. But long story short, then they failed to file the 10K and the auditor finally resigned. And when SMCI put out a press release announcing the auditor resignation, the auditor filed a letter with the SEC saying, "We agree with certain sentences in this press release." Now, that is the kind of statement you will almost never hear from the auditor. But ENY has been in a lot of pressure because ENY has rubber stamped quite a few frauds, and so they are probably looking to save their reputation. They don't want to be the next Arthur Andersen, which was the firm that went down with the Enron scandal. So ENY backed off. And even after that, the stock didn't correct as much, which was something that is just so puzzling to me. And now, finally, on the eve of it being delisted, people are paying attention. So, this is NVIDIA's, the way it ties to NVIDIA is Supermicro Computer is NVIDIA's third biggest customer. Now, if the NVIDIA story is all about its earnings beats quarter on quarter, the revenue growth quarter on quarter, what happens when its third biggest customer kind of goes bust? And no one's asking that question. And even the if you ask that question on FinTwit, you get a lot of comments from people saying Supermicro Computer is not the end user of NVIDIA's products. They just take the GPUs, put it along with their racks, and ship it to the end user, which is the Microsofts and the hyperscalers of the world. So the people's argument here is that Supermicro's demise won't really affect NVIDIA because they'll just route their supplies to Dell. But I mean, like if you are in the software business and or if you are in the newsletter business, let's say I have 100 subscribers today, 1,000 subscribers tomorrow, easy to scale. 10,000 subscribers, still easy to scale. And if you're using Substack, I don't know what the limit is, but I'm pretty sure you don't have to worry about a thing. They'll take care of the scaling. Whereas when you're shipping server racks to data centers, it is not that case at all. But people just don't understand the fundamentals and they are still fighting and fighting. And it's very similar to how what we saw with Bitcoin in 2022. You have a bear market, 40K, 30K, people just keep buying because it's value all the way down to 15K. And then they get into a funk because they lost so much money. And I think we are somewhere in that part of the cycle now. And Nvidia reports earnings next week, and there have been a raft of sell side analyst upgrades this week. Now, I don't know whether they don't understand what's going on or they are doing these upgrades in order to provide exit liquidity. Because if you understand how ratings upgrade work and how the algos work, every time there's a EPS revision higher or there's a rating upgrade, the algos buy the stock. Now that creates volume for active investors to sell into. So I don't know if these sell side firms are doing this deliberately to create that volume, or they are just so stupid that they believe Nvidia will keep beating its earnings forever and they can keep raising their price targets forever. But either way, this is a fraud. This is going to blow up either when Nvidia releases their 10Q next week or when PwC has to sign off on their audited financials in January. So at one of these 2 points, I think it's going to come to a head. And if you think the current correction in the Nasdaq is a dip worth buying, I would suggest looking elsewhere. Maybe look at software, maybe look at anything else in tech, but not the hardware space, not the semiconductor space. Now, I'll pass it over to Sam so you can tell me how the charts are looking for SMH and NVIDIA.
Yeah.
Yeah, for sure. It definitely looks like SMCI has rolled over and completed this top, and I think it has downside towards $4. And like it's already down 85% from its all-time high, but there's not a lot of support until $4. So we'll see what happens there. But Jason just threw up my SMH SPY chart, that has my attention. So this is the short-term look at it. You have a potential head and shoulders pattern carving out here, and then that monthly chart, Jason, if you could throw that one up. So you have that short-term potential reversal pattern shaping up in the context of a long-term momentum coming out of this name. You have a bearish PPO crossover on the monthly chart. I think a retest of that dot-com bubble high would make a lot of sense, and that's quite a bit of downside from here in relative terms. So I find it hard to be bullish on the industry group right now.
And yeah, at the same time, just looking at the relative strength, that to me is always the go-to for all these things. And this is a great chart, Sam. Just taking a look at the relative strength, you're seeing lower highs here. You're saying it's not performing the S&P 500 anymore. That hasn't happened since this huge move that happened in 2023. So that huge move that happened in 2023, where Nvidia continued to just hold up, because let's be honest, the SMH is just mainly a Nvidia ETF. Like, sure, there's other things in there, but SMH is
You can look at a SOX SPY ratio and get a very similar story.
Yeah, you'll get a very similar story for semiconductors altogether, but SMH is very heavily weighted in Nvidia. Nvidia has been a major underperformer lately, and so is the semiconductor sector. And what we're seeing here is more of a broadening. The thing all of us have continued to kind of talk about again and again, which is, hey, tech is cool. Tech made us a lot of money, but there's other areas in the market to look at that are looking really good, holding up really well. And you don't have as much exposure to these things that Kashab is talking about at the moment. So I really like that idea. So getting into the next part, let's talk gold. I know everybody's going to have questions about gold right now because gold is down. And when things are down after they've been up, it's the end of the world. That's the end of it. So I'll pass it to Kashab, and then I'll bring up Sam and Sam's charts. So Kashab, what are you thinking about gold, the gold miners? Like, we saw some of the major names get beat up really badly, NEM mainly. So what are you thinking about the gold miners? I know you warned people about NEM a while ago. So what do you think about the gold miners, gold, silver, viable dip, or is it something that's just starting and it's going to head a lot lower?
So this is my favorite time of the year when it comes to the gold miners. And in fact, it's so tied up in my life that I got married on October 18th. And the reason we chose that date was because there were no earnings calls and it was just before tax loss season. So there was no way I would be distracted by the markets. And the reason we did that is because, like, then the earnings call starts, and after that comes the tax loss season. And what is the tax loss season? You have the big funds. They are not traders. They don't book business income, right? They book capital gains. So what they do is that they take the last 2 months of the year to clear out all the clutter, all the underperformers, and they need to use the tax shields in order to offset the big winners. So what they do is they start selling all these stocks, and because they start selling all these stocks, everyone starts selling all these stocks. They break down, they have low momentum, and there's no buying volume. So this is the time of the year where prices really disconnect from fundamentals, and there's a good reason for it. But it's also an opportunity if you're not someone who's bothered by the weakening price action. If you really know the fundamentals and you know why this is happening, it's the perfect time to buy. And the gold miners, anything which is listed in the Canadian exchanges, always takes a big hit around this season. So I'm just sitting with plenty of cash looking to buy. And it helps that gold is also having a correction right now. So that's kind of driving a little bit of panic in the market. And I don't know about the seasonality for gold, but if you look at the miners, uh, Jan and Feb, I'm not talking about the big miners, not the GDX, GDXJ, the small cap names which are not in the ETFs. January and February are the times where you can get 100% return in these names. Like, you buy in November, December, by Jan, Feb, you'll have 100% return on some of these names. So it's a really, really good strategy. It's something that I've been doing every single year since around 2016 or 17. So I'm very, very excited, and I'll probably for subscribers, I'll probably put out a list of all the names that they should be buying during tax loss season once it progresses.
Kashop, what do you look for in these stocks for the strategy that you're talking about? Are you looking for just the hottest piece of garbage out there that's really beaten down and can pop the most, or is it just a matter of looking for leadership inside
No,
of the
so
industry?
the pieces of garbage, once they get sold, they are mostly down for the count. So I'm looking for the good stocks, which, so let's say something had a good run up from Jan to June and then kind of has gone nowhere. So what will happen is people who got late in on the momentum, they'll start selling. So at that point, the good stocks, even though they may be up year to date, they start going down. So that's the dip that you want to buy. Whereas if you actually look at a chart, there might be a trend line break, so it looks scary. They may be, selling off on heavy volume. So as a trader, you would look at it and say you should not buy these stocks because they have a lot of downside. But if you understand the dynamics of tax loss season, and if you understand the fundamentals of these stocks, and if you understand the fact that management of these companies will not do anything crazy during this season. For instance, when the stock price is declining, they're not going to go out and raise equity because they know what's happening. So if you pick companies which fit, it's a very, very niche trade. So you really have to be in the know, understand the fundamentals. And I mean, it helps that I've been doing it for close to 8 years now, so I know what's going on. But otherwise, it's a niche thing. You cannot screen for it because when you screen for it, all these stocks will look as terrible as the garbage. So you cannot really differentiate.
It's hard. It's hard in the gold in the micro gold mining space, or the juniors or the explorers, because you run into so many. They're digging into a hole in the ground, and what the hell is actually in the ground, and it might be nothing. There's just so much things, and that's why somebody like a shop is very valuable. Just to understand, like, if you're really going to get into that space and dig into it deeply, you need somebody who really knows what they're doing. Kashop has a great report where he talks about a lot of these names. So if you guys check that out, go to his page. That's at his on his Twitter. You can find all of his links there, and definitely check that out. So getting into just gold, like let's just talk gold in general, because gold has been the one that I mean we've gotten so many questions about it. Sam and I, we run the Gold Rush at All Star Charts. Questions keep coming up day after day. What's going on with gold? Is gold going to crash? Is this the end of the gold market? So what do you think, Sam? I know you brought some charts. What are you thinking about gold?
Yeah, short term, it looks pretty messy and difficult to buy a tactical bottom. I think you need to give it more time to shape up before you think about buying. But I just outlined this 25.5 level as a potential level of interest for buyers to begin accumulating once again. It was resistance for several months earlier this year in the summer. So it would make sense for us to pause there again. But just generally, I am very bullish gold. It has broken out of a multi-decade base and just recently made a new all-time high. So I think this is just a normal correction in the context of uh, really a new secular uptrend. I think that could be here for many years. So in that context, I think you should be looking for dips to buy.
No, I agree with you, Sam, and that's the same thing. It's the and Kashop, you mentioned earlier the idea of seasonality in gold, and you talking about the miners, but as you know, the silver has really good seasonality getting into year end and through January. Ridiculous seasonality, almost unbelievable seasonality. I think it's up over 90. It's up over 90% of the time in the last 15 years. I mean, it's something really crazy in January.
And I think the inverse of that, Jason, is we've been really pounding the table on bearish dollar bets.
Yes,
So like if that's gonna happen, it should happen like right now. Like we're at the top of that range in the Dixie. So
and I brought our chart, and I know this is a little bit off of gold, and this might be something just for people to pay attention to. But Sam and I have kind of talked about the dollar and the fact that the dollar could probably go down here. It's right at the top of the range. It looks like it could reverse. This will give a big boost to gold. could give a big boost to things like Bitcoin. This chart, I looked this up and kind of went through it and was like, man, this is really what fuels a major Bitcoin cycle. So if you're going to see that major move over that 100,000 level, like you have to see the dollar come down. But also, if you see the dollar come down, that means gold will go up. It'll also help a lot of the commodities as well. So I think it's interesting to just look at the whole complex right now and just see this down dollar environment that could possibly happen and what it could do to most of these markets. Speaking about something that Sam, you and I have talked about a bunch, but it's a great time to pass this to Kashop. What are you thinking about the energy sector holding up so well with oil putting so much pressure on it right now?
Sure, and I want to hear your thoughts on the different industry groups as well,
Yeah.
Kashop.
Sure. So energy, I think this is the time to buy the Canadian and US oil producers. This is the time to buy the onshore US onshore drillers, that is the oil services stocks. This is the time to buy the offshore sector. Now, I know everyone talks about offshore all the time. It's a great bargain. It has been a great bargain for the last decade. So, the way to play it is to buy it when the sentiment is at extremes like we are at now, and to sell it when it gets euphoric, because this is a value sector. And with value sector, what happens is they permanently stay value sectors. That's why they get the name as a value sector. So you will always find a fundamental reason to be bullish on these stocks, but it is still only good for a momentum play. And the reason for that is because of the debt. The industry has so much debt, and because they have so much debt, they keep going through that cycle. Now, you can find companies that are in secular uptrends because they have got rid of the debt through bankruptcy or something like that. And if you find those particular stocks, like for instance, Tidewater or Valaris, then you can have a long term uptrend. But overall, if you're buying the ETFs, then you have to understand that the fundamentals always look good in terms of price to book, price to earnings, all of that. But the problem is the debt they carry on the balance sheet. So this is the perfect time to buy the Canadian and US oil producers, dip your toe into the offshore sector, and perfect time to also get long the oil field services sector, that is the onshore drillers and all the supporting companies.
So if we're looking at that, do you think that any of this can be cleared up, the debt in these companies? Is it a situation where you're looking at it and going, that could change going forward? Or is it a situation where they're kind of stuck in this? And most companies are stuck in debt. So what are you thinking on that?
So they can get out of debt. So for instance, Valaris in their recent bankruptcy, they just cleared out all the debt. But then you have companies like Transocean where the debt, so they never declared bankruptcy, and so the debt just keeps weighing on them. And the reason they have all this debt is because in the up part of the cycle, they focused on growth. And at that point, the debt didn't matter because interest rates were at zero starting from 2008 all the way to 2015, and even then it was just a 25 basis points hike. Like who cared? So when you have this long era of low interest rates, the theory for all these capex heavy companies was just borrow and use it either to expand or to do buybacks, because conventional finance says that buybacks are accretive to equity value and debt and equity are the same. So interest rates are 0%. Why are you not borrowing? So all these companies borrowed too much, gorged on capex. Some of them even did ill-advised buybacks. And the consequence of all this is Fed funds is now too high. And all this debt, it has to keep getting rolled over because there is no way the cash flows can finance this debt. And because the interest burden is increasing and oil prices have kind of come really off the 2022 highs, it's getting really hard for the oil producers to invest in capex. So whatever the oil producers invest in capex, part of that goes to the oil services companies. So if you don't have them growing capex, then these companies suffer, and that's really the problem with being a picks and shovels play. Like everyone talks about the gold rush. Levi Strauss made a lot of money selling jeans, but that strategy only works as long as there are new ships coming to San Francisco with eager people, wanting to go prospect for gold. Once that rush stops, what happens? The jeans don't sell. And it's the same way with the oil services companies. So when the capex growth stops, what happens? they just get stuck with all this inventory of rigs and equipment that just doesn't get used. Think of, like you had this big oil boom in North Dakota when backend was discovered. And if you had a trucking company, or if you had opened a restaurant there, or if you had bought a lot of commercial land there at that time, what do you think happens to the value of all that land now? Because it's just of no use. It's like, think of it as having tractors near New York City versus tractors in your own backyard. Like, there's a big difference. Even though the equipment is the same, the utilization of that equipment suffers because the region has changed. And that's really the problem with that sector.
No, that makes sense. So getting into, so we talked energy, we talked gold, and feel free, guys, if you guys have questions. I know there's a lot of people in here right now. Feel free to write in, let us know whatever you want to cover. So Kashop, you mentioned another thing, which was, and I was thinking about energy, and I was like, oh, maybe I should ask you about Oxy. But let's move past that, because you mentioned something about Warren Buffett and his cash hoard. And he's got a lot of cash on the books right now. You mentioned that in your newsletter. I have a view on it too. I'll get to that after you do. But I want to hear, like, what were you saying in your letter? And for you guys that don't subscribe, make sure to subscribe and support the writer or the writers and the speakers on here, Sam and Kashop. So, what were you talking about in your letter the other day? Just give people a little bit of a background in what you were saying.
Sure. So if you look at Warren Buffett's cash flow, so Berkshire Hathaway is now $1 trillion company. So if the cash pile is growing, the market cap is also growing. That's all good. But if you look at the actual chart of their cash pile, it's gone parabolic. Now you can go to the St. Louis Fed database and you can pull up all sorts of data. Like, they have a ton of data for free. If you pull up money market funds and you look at the balances at money market funds, you will see that that's hitting all-time highs. So Warren Buffett is hoarding a lot of cash. Investors are piling into money market funds. So money market funds are considered safe. Like, you get a yield, but $1 will always be a dollar, even though the debt in that those funds never goes bad, or at least that's the theory. So it's considered as safe as having money in your bank account, which is why people hold money in money market funds. So Warren Buffett's cash hoard, money markets funds cash hoard, you take all of that put together, and the picture is something different from what you would hear on the media. So Stanley Druckenmiller is a bond bear, and he's been very, very forceful on it. And if you go to pretty much any hedge fund letter or any macro fund manager, they would tell you they are bearish bonds. And why they are bearish bonds is because inflation is going to rise. And they have all sorts of explanations for why they should be bearish bonds. And so they're selling the futures, and yields are going to skyrocket and whatnot. But all of this contradicts what you see with Warren Buffett's positioning and what you see with the money market funds. So, my take is that the Fed has lowered its balance sheet back to May 2020 levels. And that's something no one's talking about. Like, they've been saying they are going to hike rates and do QT, but the market didn't believe them. And the market had good reasons not to believe them, because the first sign of trouble at Silicon Valley Bank, and within 10-20 days, they undid 1.5 years worth of QT and sent their balance sheet right back up to the previous level again. And since then, they have kind of started to taper down, but they have played other tricks, like with the reverse repos, and the treasury has flooded the market with liquidity. So all these factors have just created. Plus, it's the whole thing with memes. Once money printer goes per as a meme takes hold, and you see Bitcoin going up, which plays very well into that meme, because Bitcoin, it symbolizes the fact that money gets debased, and because this is a program, this is algorithmic, the money supply is going to only go up at a fixed rate forever. So when you have that whole narrative take hold, everyone has this misconception that the Fed is printing money. And then you have this news of the Bank of China, the PBOC printing money. But all that aside, if you actually go look at what's happening, what you see is cash hoards are rising and the Fed is shrinking the money supply. Now, this creates a situation where, and the other complication here is, so just remember these two things. So cash piles are rising, the Fed's balance sheet is shrinking. And on top of this, you have a situation where bank credit is at all-time highs, bank deposits are at close to all-time highs. So what is this telling you? The whole thing looks kind of ridiculous, but if you just, and that's why macro is a puzzle, you piece it all together and then you go look at what's happening in the yen. Like today we saw a massive move in the yen, and you piece it all together, this is a deflationary shock. Now, or let me at least say this is a disinflationary shock. It's not deflationary yet, but it is definitely disinflationary. Now, how long will this last, and will all disinflationary episodes lead to market corrections? I don't know, because this cycle is unique because this follows the fastest Fed rate hike campaign in history. The cycle is unique because the public debt is now at such an exorbitant level that there's no way it will be paid back. This cycle is unique because $2 trillion a year deficits are no longer a cause for concern. And this cycle is unique because the Fed has flooded the system with so much money that whatever they try, they are just simply unable to cause a correction. So you have all these factors making this time really unique. But at the same time, what you can see is that something is off. Now, for me as a trader, when I see something is off, something doesn't reconcile, the easy thing to do is to just go to cash and figure it out later. So that's what I have done. So I've liquidated my entire crypto portfolio. And the reason I did that is because, firstly, I had a 11x winner on Solana, which I bought last June when Robinhood delisted it. So when you have a 11x winner and you get antsy, and first of all, sitting on 11x winner is really, really difficult because it became my entire crypto portfolio at that point. So I put all of this together and I decided to just exit, sit on cash, and await developments. Now, this way, whatever happens, right or wrong, I'm not hurt that much. Now, cutting winning trades short, yes, is supposed to hurt, but with crypto, there are always accidents, and it's not as straightforward as what you do with your regular brokerage account. So I find that putting all these factors together, it's best to just sit on cash, deliver, and especially because now the tax law season is coming up, I'm anticipating buying all the bargains that I'll find at that point. So I'm just sitting on cash and being a macro doomer. And I don't expect to be a macro doomer for a really long time, probably another month or two. But right now, that's where I am.
No, I like that because it's I think even though like I'm not a person who's ever gonna I don't sell out my entire positions because I think winner has gone too far or something. I'm not that type. However, I do think there's a point where you have to either one take breaks and know your strategy. Over everything, I think the most important thing as a trader is to know your strategy. Cutting losses short, letting winners run, all those things sound really cool, but understanding your strategy is really everything, which is at certain points, maybe that strategy means, hey, I take a lot of money out, I sit on the sidelines, I wait for an opportunity. It's kind of like Warren Buffett. You know, I'm not a person who looks at things Warren Buffett does and go, I have to do that. That doesn't make any sense for me or my time frame. However, it makes perfect sense for him and his time frame. He is very successful. A lot of people have been like, "Oh, you know, he's old. He doesn't get it." He did the same thing in the dot-com bubble. And it seems like he knew. Seems like the old guy knew a little bit more than what he was letting on. And that's the truth. The guy definitely nailed the last 50 years better than just about anybody on earth. And you can't hate on it. So look, going forward into today, I see that he's got his cash hoard, and that's not going to change my positions, but it is something to pay attention to, especially if you are in that time frame or if you are looking for bargains. So once again, and I looked over his portfolio recently. Just yesterday, the 13Fs came out. Seeing him selling, you know, a certain amount of, you know, mainly tech, anything that was tech related, he certainly got out of. But also, he wasn't really getting out of the staple stocks. He wasn't really getting out of anything that was commodity based or producers of some sort. Like he stayed in a lot of those names. So it's very interesting the conversation you and I have had forever at this point, which is, hey, tech sounds cool, but there's other things out here which nobody wanted to hear, you know, a couple months ago. Now it's starting to be like, well, maybe. because a lot of these are starting to show some signs of underperformance, and now people are concerned.
So
However,
are
we've been
people going
talking about it
to
for a while.
yeah, are people going to rotate out of Nvidia and buy coffee because it's making all-time highs?
Yeah. I mean that's the thing that's funny is like now here's a cool one. Robinhood, looking at over it, we talked about it on our analyst call the other day. Going to Robinhood and just looking through and seeing like, oh, what products do they have? And it was like, oh, they have a lot more than people thought in futures. Seeing the products like oil, natural gas, just anything CME based looked like they really got on board with. So that's really cool, and that's kind of a big development. So you people out there who have Robinhood accounts, like that'd be cool to see them start to trade some of these micro futures contracts. But like you said with coffee hitting new highs, like we have a lot. The softs look great, and that's something that a lot of people, nobody's talking about at all right now. They're like, commodities are dead, they're getting killed. It's like, you're looking at oil. You are just looking at oil and energy, not even natural gas, because natural gas looks really good.
Literally nobody cares about the softs, Jason. Nobody
Nobody
talked about
cares about
cocoa until it was up 500%.
Nobody likes,
You know?
nobody likes to talk about them. And Sam called me out on Monday and was like, hey, look at this chart of cocoa. And I was like, yeah, probably won't give me a new signal again. And Sam was like, I'll fade that all day. Sam was absolutely right. The next
It
day I
worked
get a
out.
new signal to get long cocoa, then literally the next day. And I go, yep, Sam, you were right. So like once again, all of these things are moving like crazy from the
I
like,
think
and
I
somebody
wanted
said
to
the other
mention
day,
with
go ahead, Sam.
Warren Buffett, like the last time he was getting criticized for having this much cash was like the dot-com bubble. And during that time, we had a pretty good commodity bull market until the great financial crisis. And he bought BNSF and he bought Berkshire Energy during that time. And those both turned out to be tremendous investments. So I wouldn't be surprised to see him do the same thing this decade, just maybe buy another railroad, buy a utility, buy some type of energy stock. He's been buying Occidental Petroleum. So
Start
I think that
shifting,
continues. I think that just speaks to his macro view of the world, is that maybe that is the place to be. And the
That
risk
is
reward isn't
interesting.
great in technology stocks.
That is interesting, Sam, and something that I didn't think about, which is they're very true. That time that I was talking about earlier, which is when everybody said he was old, he didn't know what he was doing anymore, and he didn't buy the tech stocks during the dot-com bubble. That at that point, right after that, that was when money just flew into the commodity space, the gold mining space, the microcap space. So basically, like he was spot on those things. So once again, I'm not bearish on everything. I am saying that it's been the time to kind of get out of tech and rotate for a while and look for new opportunities.
And might I add, Jason, he's
Please.
also been dumping is it Citibank, the shitty bank? He's been
Mhm.
dumping that and buying insurance stocks. And I think that speaks to his view on the bond market, is that maybe these banks with a lot of debt on their balance sheets that is underwater, like the shitty bank, they might be in trouble. Like the bond market might be in a prolonged bear market, like we've been saying.
Yes.
So
I honestly think that it's two things. For the bond market, I think you could be very safe being in the front end of the curve. If you really want to be in the bond market, which I don't think everybody needs to be in, but I think you're very safe in the front end of the curve. I think the long end of the curve, there's going to be trouble. I think, like Ashop said, the thing that I keep talking about and the thing I keep seeing is that there's either two ways this is going to go. We have a disinflationary shock, and then we have a crazy commodity bull run. Or we just have a crazy commodity bull run at some point, and we already saw kind of the disinflationary shock where bonds gave that false signal and basically turned around really quickly. Bonds basically made 52-week highs across the board and then reversed very quickly. So it's kind of I want to wait and see here, like in the bond market is especially that. But for now, like we're short the long bond at the moment. Not really. We're long the Eurodollar futures, so we're on a spread right now between those two, and that's honestly what I see this environment being. If we're going to come out of a yield curve inversion and the curve's going to get steeper, That usually leads to higher gold prices, higher commodity prices, inflation coming back up until they get to the point where they go, well, we can't continue to lower rates here, and then that changes. So I guess the thing, another thing that we could kind of end on, just talking about the Fed. What I want to leave here with a big idea of what is going on with the Fed. Do we think the Fed can continue to lower rates here and they will no matter what? Let's say inflation, first off, let's say inflation keeps going up. Let's say it keeps ticking higher slowly and then all at once. Do you think the Fed would just continue to lower rates here? Because that's something that I've been grappling with. I have a view on that, but I want to hear Shop and Sam's view first.
I think the Fed has become impossible to predict. The Powell's statement saying he will not step down when he is asked is like just no, no. And if you look at the timeline, I mean, they say they're not a political institution, but to me, it reads like a very political institution. 50 basis points hike, reading light up to the election rallies. So, you boost the economy and make it all look good. And then once Trump wins, you cannot just not cut the next day. So you go with a token 25 basis points cut. And yesterday, Powell comes and says future cuts are going to be data dependent or we're not going to really cut. And that is such a big change in tone from pre-election to now that it just looks completely political. And maybe they are not, but it completely gives the wrong impression. And I think the Fed and Trump are really going to get into it, and we're probably going to have. So when the Fed and the president get into it, I don't think it's going to be good for the economy because it just leads to so much uncertainty. And there is a theory proposed by the Austrian school that it wasn't the Fed rate hikes or the end of the 1929 stock market crash that caused the Great Depression. It was actually regime uncertainty. So if you Google, there's a paper by a scholar named Robert Higgs, right? He says regime uncertainty is the cause of the Great Depression. And if we get Trump and Powell at loggerheads and there's kind of a gridlock there, or multiple reports coming out, or Trump tries to remove Powell for cause and nothing happens, or they fight back, all these sorts of questions is going to create so much regime uncertainty that it is not going to be good for the American economy. And it's definitely not going to be good for the stock market because the stock market has always had the Greenspan, Bernanke, Yellen, Powell put. So there's a term for it, the plunge protection team. And whether it's mythical or whether it's not, just the fact that people think it exists has kind of always put a floor under the stock market. So if that is gone, then you don't know what's going to happen. So I think Trump and the Fed getting into this kind of argument is going to be very, very negative for the stock market. But we'll see how it plays out. Maybe this is all just bluster. And once Trump comes in and tells Powell, you have to go, then he leaves. So you don't know what happens. Or maybe just Powell plays nice and starts cutting rates because that's what Trump wants. So just remains to be seen. And I think there's no point trying to predict it right now. There are trades that you can take based on the COT or based on your thinking about the macro. Just take those trades, and if the Fed does something, then you're forced to reverse it. And I think everyone, as a trader, we kind of have to live from one Fed meeting to the next when we are playing these meetings. Like if you're playing gold or if you're playing some commodity or say software stocks, then of course you have long-term trends. But if you're playing rates futures, then you definitely have to be watchful for this.
Sam, what are you thinking?
Yeah, for me, I don't really know much about the Fed. I really have no edge there. But looking at a ratio like DBC SPY, I believe we're on the verge of a fresh wave of inflation. And this DBC SPY is a great indicator for that. It called the top pretty damn well in 2022, called the bottom in 2020. And today, DBC SPY is at that same level where it bottomed back in 2020. It has also carved out a bullish momentum divergence. So that for me is front and center. And if inflation's coming back, interest rates probably aren't going lower. And that's what the market's been
So
telling us. Like since the Fed cut, interest rates have gone straight up.
So inflation probably comes back, but what they do is they change the methodology. So April they removed coffee because coffee started making new highs, and now there's talk of changing the calculation for healthcare because healthcare costs are too high. They're going to do something by changing the methodology there. And probably now the next worry is shelter inflation, and because it's owner's equivalent rent, which is a completely made up term, which has no relation to whatever rent you pay, so they can just play with that number. And I don't know what happens. Probably they remove gasoline and say electricity and gasoline should go together because, electric cars, who knows? But
Yeah,
I'm
Yeah.
pretty
Prashant,
sure
that
they're going to.
seems like a systematic issue to me. So, like, if you just keep on removing these elements of the calculation, like, what the hell do you have at the end of the day?
That's where we're getting. That's where we've gotten to, and it's funny because
Like,
somebody mentioned something about my chart of the 70s and the and today, basically looking at inflation in the 70s compared to today, and they were like, well, it's interesting. Like, I wonder what that would look like if you actually kept the CPI, the same formula from the 70s to today. And I was like, well, it would look absolutely insane, really. And that's the answer to a lot of the questions here, which is this is why I look at the charts. I look at the commodities. I want to see what's going on with oil. And then I try to make everything else from there. So if I'm seeing oil moving up, which it's not doing anything today, so I'm not saying that it's moving up. I am saying that there looks like there's a possibility of a lot of these bottoming out. If you look at the whole complex, sure, there's people who just look at oil and go, see, commodities are dead. They look at oil and gold in the last couple of weeks and go, see, commodities are dead. You guys are idiots. And really, like, there's a lot of commodities out there and things that aren't in the CPI report that are going to show up first. Like looking at cocoa is not something where I'd go, oh, yeah, cocoa is going to bleed into the rest of the commodity market and it's going to send all the commodities higher. No, I'm not going to say that. But if we look at the rest of them, and we start to look at the softs and go, okay, lumber has been on a tear. Nobody's talking about it. It has been a great trade since we put that on. It has moved up, I think, 11%, something crazy right out of that band squeeze. I don't think it's even taken a day off. Maybe one down day in this entire time. That looks really good, really interesting.
I
Cocoa,
wanted to mention on the show, the home builders have been leaders during this bull market, and you mentioned lumber ripping.
lumber
Why
ripping, and
aren't
then
the
home
home builders
builders.
participating?
Yeah. So because it's two totally different things, but a lot of people put those together, and it's like and once again, it's what are the home builders actually producing the lumber? Some of them have forest, but not many of them. Who does have a lot of forest are the paper producers, International Paper, Weyerhaeuser, things like that. Like they have a lot of forest. They actually have um, the ability to produce paper and lumber on their own. So once again, you're going to see those divergences continue to happen. I think it's really important right now for people to look at the actual commodities. For me, the Fed, if I'm just taking a look at it and going, okay, they have to save face, right? I mean, like I can't stop showing this picture, but it's just so damn funny because the last the last Fed meeting was just this over and over again. We won the war. I'm not stepping down, like kind of like in Wolf of Wall Street. I'm not leaving, like that whole thing. Um, and then he just continued on this road, like, yeah, we're doing great, inflation is great, everything's doing great. Well, and then the next thing, what do we hear, Kashop? The next thing's gonna come out. Oh, well, we did see a little bit of an uptick in inflation, but we knew that was going to happen. It's the holiday season. So that's the next thing we'll probably see if inflation does start to move higher. And then next year, it'll be some other word. They're not going to use transitory again because they can't, but it'll be some other word that they're going to try to use. They said it was transitory inflation all of 2021. All the commodities were ripping higher almost every single month. I don't know if oil took a month off. I don't know if a lot of the commodities ever took a month off in 2021. But he continued to say inflation was transitory. So I do think that they're going to cut no matter what. That's my biggest thought right now is that they're going to cut in December no matter what. They have to save face. They're probably going to cut again in 2025 to save face and say everything's going great. We're going to continue to cut. I think they kind of have to. If you're Powell, not saying they have to do anything because they're the Fed. They can do whatever they want. But I think they're going to have to save face. And then after that, they might have some hard decisions to make. But who knows what the market looks like at that point? That's the thing to me is like, what is tech starts to really lag? What if you're right about NVIDIA? Like what if all these things start to come into play, it's like, okay, what does the market then look like? And what type of pressure does that put on the commodities market, the Fed, and so on? So I think right now I'll continue to take the trades, ride the trends, but there's always reasons to be cautious. And most of the time, the best money is made when you should be cautious. But once again, it's what you and I had a talk about a long time ago with Bitcoin. Understanding your exit. That is everything. Understand your exit, meaning like Kashop said, hey, I'm going to get out. I'm going to put some money aside. I'm going to start buying my gold miners like I like to do every year. Fantastic. That's his methodology. My methodology is I'm long these trends. They're all in uptrends. I could really care less. When it hits a 50-day low or a 60-day low, I'll be out of those positions, and that's it. That's my methodology. So understanding how you're going to trade these things and understanding and having an exit signal right now is really important.
Yeah,
Totally.
absolutely.
My eyes are on the generals right now. Like that semiconductor SPY, that's front and center for me. If these generals start getting shot, I think we start to see deterioration in breadth and trouble next year.
Jason, what do you think of the agribusiness ETF? I think that's something we haven't spoken about
Sam,
for
is
quite
it
a
your
while.
birthday? It's your birthday today, Sam?
Yeah.
Oh, happy birthday,
My brother's
man.
in the chat here.
Oh, cool, man.
I
I
told him
didn't
not to
know he
mention
didn't
it.
even say anything. So thanks for saying something. And happy birthday, Sam.
Thank you,
Happy
guys.
birthday, Sam.
Thank you so
And
much.
wow, 22. That's a milestone birthday.
Yeah,
It is.
that's awesome. Sam's gonna own all the whole world by the time he's 30. He's gonna be the top name in finance by the time he's 30. I know it. So let's hop into it. We'll end there. What were you gonna say, Kashop? Sorry to cut you off.
The MO ETF, the agribusiness.
And what about
What do
it?
you think? What do you think? Like, we haven't talked about agriculture, the ETF side of it in a while. So, where do you see that? How does it look to you from a technical perspective?
So agribusiness ETF, Moo, and a lot of the businesses inside of it, they don't look as good. Like I thought the trend was possibly changing, and we did have buy signals ready to go out, and then they never happened. So I do think that they just need some time. I think the biggest thing here is like the trade is going to happen in these commodities and commodity producers, like the agribusiness ETF. I mean, DBA has been a major outperformer, and a lot of people don't know that. They continue to point at, oh, cocoa was the reason why I was the outperformer. Yes, it was at one point, but it's continued to hold up this whole time. A lot of the commodities have done pretty well. They've held up decently. So I do think that these are going to start moving at some point. I think this is really where you want to start looking for alpha in your portfolio, and probably getting into next year. I don't think it's going to be something where we're going to see it really move, but next year that should be a interesting theme that could continue to happen.
Totally. It looks technically a lot like solar to me right now, Kashop. Both in absolute and relative terms. You have that the prior cycle high is what's really important in absolute terms. Plus, you don't really have any downside momentum left in this. It looks sold out to me, and just it looks like it's trying to churn sideways here and carve out some type of bottom. But on relative terms too, it looks pretty interesting with that massive bullish divergence versus the S&P 500. So good call out there. I think that's interesting.
Yeah, I'm watching it. I don't have a trade on it yet, but just looking to see how it goes.
What companies does this ETF hold?
I don't know, actually. I
You-
just know the
Sure.
ETF.
That's something we could maybe go through next week, and even on the commodity report. There is a ton of companies in there, and we could kind of go through them and kind of talk about what we're thinking about all of them. If you guys are interested, I know a lot of people don't want to talk about ags, but man, a lot of money can be made in these, and they were outperformers for many years in the past. They were outperformers in 2020 and 2021, late 2020 through 2021. could be outperformers again. So we'll talk to you guys next week. Thanks for joining us. And make sure to follow the speakers, Sam and Kashab. And if you check the description on YouTube, you guys can subscribe to our channel, see my last report talking about all my trading journeys and difficulties and rewards. The whole journey's in there. So, all right, guys.
Real authentic.
It's real authentic.
Yeah.
It's the truth. Well, it's the truth at least.
I love that, Jason.
See you guys later.
See ya.